Hi, good morning, everyone. I'm Jialin Chen, one of the conference session moderators for the 2024 Capital for Good conference. Our next panel discussion will be on the topics of impact investing as a tool for resilience. Please join me in welcoming our panelists to the stage. Joining us today is Jennifer Louie, Managing Director at Closed Loop Partners. Welcome. And Vikas Raj, co-founder and managing partner at ResilienceVC and adjunct professor at Columbia Business School. And Courtney Thompson, executive director and head of sustainable products and solutions, Global Sustainable Office at Morgan Stanley. Welcome, everyone. Courtney, I will pass the mic off to you for the discussion and come back for the Q&A.
Perfect. Thanks so much, Jialin, and thanks all. I hope, it sounds like this is working well. Thanks all for having us. We're so excited to be here for this discussion on impact investing as part of Capital for Good. This panel, as you may know, is brought to you by Leo Impact Fund, which is one of the recently rebranded but longest-lived student impact funds in the country at Columbia Business School. Vikas and I are both proud alums, and we're so excited to have Jen join us today on this panel to discuss the space of impact investing, which we've seen grow exponentially over the years, both in AUM in the market and among students at Columbia across schools, particularly at the business school. I'm going to assume that most people in the audience today are relatively familiar with impact investing, but I thought just to level set very quickly before we dive in with our experts here on the panel, actually just this week, the Global Impact Investing Network released a new survey quoting the impact investing market globally at over 1.5 trillion. That's over 20% growth from just 2019 and represented results from over 4,000 impact investors. I thought it was interesting. I thought I'd reflect as a CBS alum. I looked back at some data from when I was applying to business school. And in 2014, not to date myself, I found an old GIN survey that surveyed only 125 impact investors seeking to deploy about 10 to 12 billion in impact capital. So I think this is a really exciting momentum over the last 10 years, and we're super excited, again, to bring to life the real experience of our two experts. The last thing I'll say to level set just behind the scenes of impact investing, some of the largest allocators are pension funds, insurance companies, and banks and sovereign wealth funds. Smaller in the GIN survey, but really meaningful, and I think we'll get into today. We have foundations, endowments, and family offices, as well as corporates allocating to impact capital. And we see impact investing as a tool. Today's panel is really framed around resilience, but underneath resilience, we see climate change, water solutions, community development, the circular economy, financial inclusion as really key themes when we think about impact and resilience overall. So I'm going to actually keep intros very short because Jialin helped introduce, and I'm going to have our panelists introduce themselves as we move in. But I wanted to start maybe with a first question, just knowing that our audience is very indexed to, I believe, a lot of students in the market. Maybe just to start, Vikas and Jen, my first question is, did you initially set out to have a career in impact investing? Or how did you get to where you are today?
Sure. Hi, everybody. Vikas Raj. I really like the title of this session, because I founded a firm called ResilienceVC, and which we'll talk more about. How did I get started? I don't think I went to college in Philadelphia, graduated in 2004. I don't think I left college thinking I'm going to be an impact investor. Impact investing as a term didn't exist when I graduated from college. I graduated from business school in 2010. Impact investing as a term had just sort of started. But I did sort of have this idea that I wanted to marry my values with the work I was doing every day. And I got a chance to really start that. I came out of the finance world. I was working at a hedge fund in Connecticut, and I decided to leave to help to start a micro-lending business in South India, in Bangalore, called Ujjivan. And I spent almost a year and a half there, doing all kinds of things I had no right doing as a 24-year-old. And I I raised money for them, at the time the largest fundraise for a micro-lending business. I started their first branches outside of Bangalore. They were a very small MFI at that time, and the CEO sent me to Delhi to hire a team and start loan operations in a slum in South Delhi. I helped sort of formalize field operations, given some consulting experience I had. And that was it. I mean, that experience totally redirected my life toward impact and towards financial inclusion in particular. I think, just briefly, I guess the three things that I learned from that experience, one was, if you, and particularly the leadership of an organization, figure out how to build a business by profitably, scalably serving people that everybody else thinks are too small, too risky, too hard to get to, you can actually build a big business. Ujiva, and the company that I helped to start in 2006, is now a $1 billion public company trading on the Bombay Stock Exchange. The second is how important access and how empowering access to financial products is as just a basic need for every individual on the planet. And the third is, one of the projects I worked on was helping sort of install technology at the field level. And this was in 06, 07. I remember sitting with a Microsoft consultant and a loan officer in Bangalore, in an area called Koramangala in Bangalore. And this Microsoft consultant pulled out a Palm Pilot, speaking of dating ourselves, and said, all right, you are now going to use this Palm Pilot to put all of the loan application information as you walk around these low-income areas outside of Bangalore. And you could see that this was just, the user experience, the user interface was just not there yet for this loan officer. But the writing was on the wall. She had a feature phone, this loan officer, and I could just tell that in the coming years, in the coming decade, technology was going to totally change the game and really lower the cost, ultimately, of serving low-income people and make it possible to build more and more scalable businesses. And I'll talk about how that really is reflected in my current fund.
Perfect. Jen, over to you.
So much overlap. Hi, everyone. It's an absolute pleasure to be here. I'm Jen Louie. So the short answer is no, I did not think that I would be an impact investor, nor focused on circular economy, two terms that definitely didn't exist when I graduated many decades ago from undergrad. But I did know, similar to Vikas, that I wanted to make sure that I had an opportunity in my everyday work of, where we spend lots of hours, making sure that it was meaningful to me. So I started in a very conventional finance role, similar to Vikas, then went to a hedge fund in Connecticut. And
we didn't plan this.
Probably, we were probably on the same train during the reverse commute. And then GFC happened. And it gave me a chance to really step back and reflect on what I wanted to do next. And so I moved abroad. I was always really intrigued by sub-Saharan Africa, and wanted to learn more about how I could have an impact using my finance skills. And I also first started out in micro-lending and microfinance, more looking at sort of Southeast Asia, and then found an opportunity to transition from the finance role I had in New York to a role based in Johannesburg, South Africa. And was also looking at financial inclusion, financial access, because I was still working at a very large commercial bank at the time. And from there, I became intrigued by learning more about how I could use tools, learned more about blended finance structures. And at the time, I will note that I was still working with publicly traded companies, so companies that were listed on the Johannesburg Stock Exchange. But I was learning about markets and learning about the role of capital as it related to job creation, economic development, et cetera. And then in 2017, left the private sector and moved to Cambodia to run an NGO that was focused on building an impact portfolio that was backed by family offices across Asia, and looked at clean energy, clean water access. And that was my first intentional move into impact investing. It gave me the opportunity to marry my emerging markets background, have an opportunity to expand my emerging market sort of knowledge, use financial tools to provide access to really basic infrastructure. And that's how I ended up really looking at the intersection between infrastructure, which is still my work today, and we'll talk about as we go through this session, and finance.
Fantastic. We did not totally plan this, but I think the trajectories that you've both had starting in microfinance actually perfectly parallels the trajectory of our student impact fund at Columbia Business School, which all started in microfinance before the term impact investing was coined, or maybe right around then. So fast forward to today on the fund side, we're now Leo Impact Fund. We're focused broadly on impact investing. You both are professional impact investors focused in different areas of the market. I'm curious, either of you can start, but curious if you could explain your current role today at ResilienceVC and at Closed Loop Partners. And within that, how do you define impact investing? What types of capital are you deploying? Give us a bit of a feel for your roles and your type of impact investing.
Sure. I'm happy to start. So I work at Closed Loop Partners. We're a New York City-based investment firm focused on circular economy solutions. We have 3 underlying distinct businesses that really reflect how we want to approach and accelerate the transition from a linear to a circular economy. And that approach is a innovate, invest, and operate approach today. So on the innovate side, think of that as our advisory arm. We do a lot of research. That's complemented by our investment arm or capital management business, which is where I sit. I lead our private credit and catalytic capital strategy. The other 2 investment strategies within the capital management business are a more traditional venture capital strategy, and then we also have a private equity strategy, which is a lower middle market buyout strategy. And then the operate piece launched about 2.5 years ago. It really, I think, demonstrates our commitment to circular economy, because we realized that through closed-end investment vehicles, we weren't able to positively influence what happens materials into the future. At some point, we'd have to exit, the loans would mature, et cetera. And now through the operate piece, we own and operate over 20 materials recovery facilities across the US, including the one that processes all of the recyclable materials in New York City. So in terms of the type of capital that we provide, we do everything from very early stage investments, which is the VC strategy, all the way to what I would define as fairly mature businesses that are generating annual EBITDA of $15 to $20 million. My business is very much focused on private lending. So I'm providing catalytic loans to companies that help to improve the circularity of plastics and packaging materials. Geographically, my team and I look only at the US and Canada. Over time, with that private sort of lending strategy, we've noticed that not all businesses are positioned to be able to service debt, to bring loans on balance sheet. And so we also now, within my group, have an equity sleeve to provide what we would define as catalytic equity investments to companies that help to optimize the recycling value chain. About 40% of the capital that we've provided really looks upstream and works with municipalities to provide capital for very simple things like recycling carts, recycling trucks, and then we look at more technological or innovative solutions downstream, so upgrading material recovery facilities, processing facilities, and manufacturing. And then that equity sleeve is really meant to identify technologies that optimize that value chain. I'll pause there.
Vikas.
So Resilience VC, I'm a co-founder and general partner at Resilience VC. We've only been around for about 18 months, coming up on 18 months. But we are, in some ways, a pretty narrowly focused venture fund that is investing in visionary entrepreneurs that are using new technologies, new business models to drive financial resilience for low to moderate income Americans. That's all we do. We're really just sort of a middleman in some ways between capital and entrepreneurs that are solving really, really big problems. And we're a market market return-driven fund. So in some ways, we look like a typical venture capital firm, but there's sort of two core elements of what we do that I think make us impact. One is we only invest into this problem of a lack of financial resilience in this country. We talked about financial inclusion a little bit. That was really what microfinance was trying to do, was trying to incorporate people in the financial system. That's not really the problem in the United States. You can go to your street corner and get a payday loan if you need it in this country. Most people have bank accounts in this country. Many of those that don't actually voluntarily don't because they've been burned by their bank account before. The problem here is financial resilience. The problem here is that 80% of Americans do not have $2,000 to rub together in the event that their car breaks down or their daughter gets sick or they lose one of their 2 part-time jobs. And that means that they can fall into poverty very, very easily. And they don't have the financial tools to get through those short-term emergencies and then save and invest for the future. That's what we attack. That's what our companies, I should say, attack. And that is, by the way, a massive market. The vast majority of fintech sort of investment flows, capital flows over the last decade and a half have gone ultimately to startups that serve high net worth individuals and large enterprise. So there is a massive latent market of people that are looking for better financial tools that is really not served right now. And the demand is there. If you were to look at the sort of growth in digital deposits in banks over the last 3 years, it's about 130% digital deposits, 8 or 9% in sort of traditional tier 1 deposits. So there's a real interest in being digital. The tools are not yet there. We think fintech startups have something to say about that, which is really the second core part of what we do. I sort of think of our impact in some ways as we send out the ResilienceVC logo version of a bat signal out into the world and we say, hey, look, if you're building specifically for low to moderate income Americans, if you're building a scalable model specifically for these customer groups, we're here. We will actually write you $1 million check. And we will help you after we invest scale. And by the way, we know every sort of mainstream fintech investor, so we can bring them into the cap table over time and continue to scale. So we send that bat signal out and we say, hey, we're open for business. Hopefully that moves the industry toward innovating in this space. And then once we invest, we sort of like move the spotlight down onto the companies so that people actually understand these models, so that later stage investors and regulators and partners and industry are sort of driving these models and not just the models that serve high net worth individuals and large enterprise. That's really what makes us, in my view, an impact investor.
And maybe I'll just stick with you for just a second, Vikas. I'm curious, when you decided, so you were an impact investor before you launched ResilienceVC. Yep. I'm curious, were there any changes, in addition to those fundamental market dynamics you just described, but any changes in the, call it, bigger picture impact investing market that led you to launch ResilienceVC? Have you seen any kind of transition in the market broadly?
So my previous fund was called Axion Venture Lab. It was essentially the venture program at a large global nonprofit called Axion, where I essentially managed a global portfolio of venture investments. So we invested in the US, but also in Asia, Africa, Latin America. Boy, the impact investing world has changed a lot in the last 5 or 10 years. I think one of the gaps that we realized that led to our focus at Resilience was that when you're investing in fintech for all in India or in Cambodia or in Nairobi, there's not as much of a sort of two-pocket approach. Mainstream venture investors are looking at these same businesses because they see this massive addressable market. What we realized, and I've been investing in the US in this sector for 10 years, but it was always a small part of what I did. What we realized looking more closely at the US market is there's sort of this view that either you're in the CDFI or CRA or sort of concessionary return world, or Andreessen Horowitz will invest in you, or Sequoia, a large mainstream flagship venture fund. And there's a big gap in this sector in particular in the United States. And by the way, the financial resilience of a low-income American in this city versus Nairobi or Phnom Penh is just as bad. But the players have sort of separated themselves here. And what impact investing is not saying I'm going to go get concessionary returns, at least in our version. There's many versions of impact investing, but in our version, it's not saying I'm going to get concessionary returns. It's saying I'm going to only do this. And by virtue of only doing this and having this intention, I shine the light. And I try to drive an entire industry in this direction. So that was one core insight, was there's a financial resilience sort of tragedy happening in this country, and there's not a real set of really sharp-penciled, rigorous commercial venture investors that are explicitly focused on financial resilience.
That's really helpful. And Jen, I'm curious to come to you both because Closed Loop also has a very particular focus on the circular economy, but also you're bringing a lot of corporates to the table as far as who's deploying capital, which I think doesn't always get talked about in the same breath as the pensions and the insurance companies and the banks who have deployed quite a lot. Could you talk a little bit about what it's meant to Closed Loop, or how you've brought corporates and other providers of capital to the table for impact?
When Ron Gonen, who's our founder and CEO, launched Closed Loop Partners 10 years ago, he identified a real need among CPG companies, brands, retailers, et cetera. And those are who our main core corporates, anchor corporates, have been in a lot of the funds that I'm responsible for managing, that they needed supply. They were being pressured through a variety of different channels, whether it be regulatory, their consumers, to have more sustainable packaging and products. Most of them rely on plastics, of course, but there are other material types that they have in their supply chains. And so Ron worked with the founding team to launch the first investment vehicle, which is our flagship fund, the Closed Loop Infrastructure Fund, to really set out to build the requisite recycling infrastructure across the U.S. to ensure that we were shoring up the supply that they needed. What's interesting about having corporates as partners is they all have innovation arms. Many of them have their own CVCs, large R&D budgets. And so there is a natural sort of complement between, synergies between what we do on the investing side and how we partner with them. What they're really getting from working with us is what I would define as a strategic and impact return, right? We're able to demonstrate by helping them deploy the capital that they've invested in our investment vehicles. It's essentially materials kept in circulation, right? They get contribution and attribution of that impact that goes towards their sustainability goals. The other important thing is we're able to recycle the capital on their behalf. So as opposed to making an investment on their own off balance sheet or through their foundation arm into one project, we help to spread that capital for them. We manage it on their behalf. We ensure that it operates. It meets sort of the impact thresholds and targets that we design with the owner operators. And then they're also leveraging capital from other investment vehicles. So we are targeting typically to be able to catalyze 2 to 4 times market capital alongside the investment we're making. That is pretty important to us and our corporate partners. And over time, we've leveraged this model that we had within the infrastructure fund to launch new vehicles that are very materials specific. So looking at hard to recycle materials like polyethylene and polypropylene, looking more at innovation and technology. And then from that, we've been able to bring in more institutional capital that back some of the market rate return strategies that sit within the capital management business as well.
That's fantastic. Thank you both for that perspective. I think we often talk a lot about impact investing, but really understanding who are the providers of capital and into your strategies is, I think, really helpful for the audience. And since we're in a academic setting, I thought we could pivot a little bit to a case study. Many people in the audience, myself, have been in a lot of conversations around impact investing as a theme, but I was curious if you could both help bring to life an example of, let's call it a recent or a favorite or a canonical example of an impact investment that you've been involved in, and how you've seen that play out over the years. Whether you want to name the name or just give a bit of context, but to bring it to life with a case study, I thought would be great for our audience. I don't know, Jen, if you want to start.
Happy to. So I joined Closed Loop Partners in 2020. I ended up inheriting a lot of legacy assets. So the prior investment firm had probably made over 40 investments already. And I guess as context, the capital management business of Closed Loop Partners has made over 80 investments to date, and some of that sort of rolled off, matured, we've exited, et cetera. There's one particular company that I'll maybe speak to but won't share a name of. It's in the molecular recycling space, or also known as advanced or chemical recycling. So they use plastic waste that doesn't have an alternative higher or best use that would typically just end up in landfill as their feedstock. They use molecular depolymerization technology to break those materials down to essentially manufacture or produce a wax, a specialty wax or oil that goes back into built environment applications. So it's used as an additive for roofing, as an example. When the prior investment team made the investment, the company had been operating for about 5 years. So it had operating and financial history, which is typically what we look for. We were able to quantify the impact using, again, that metric of materials kept in circulation. They were focused on polypropylene specifically, so that's also a hard-to-recycle material that typically doesn't have a high end-of-life value. And so the impact was there both from both like an impact additionality and a financial additionality perspective. They needed capital to essentially build a commercial line. I'd say there was a lot of attention paid on this, like towards this technology over time. And then they ran into some, I'd say, challenges. Operationally, just making sure that the technology was scaling. There was definitely a little bit of like a product market fit issue initially. And in December of 2021, about a year after I joined the firm, we had to do a massive restructuring. And I think it was probably the earliest experience that I had at Closed Loop Partners of really understanding the power of catalytic capital, the ability to help them free up their balance sheet. We took a significant, sort of write-off on our initial loan, but it was needed. The company needed to really deleverage. They needed a new leadership team. We helped to bring in a new management team. We helped them find a new way to think about R&D. They needed to diversify the customer base. There was a lot of concentration there. And for us, that took a lot of time. I think it's only probably in the last year that we've seen them sort of get back on track with this sort of prospect of having a sustainable, financially a solid business. And they're now looking at expansion to have a 5th line and looking at new sites across the U.S. To be able to be closer to some of their customers. I think like the key takeaways that, for me that I'd love to share is really the value that we add as impact investors, which I think is the exciting part. We're not just capital providers, like another asset management firm or, a bank. We're lending a lot of expertise on the technical side, the operational side, and then the financial side. Like our team spends a lot of time with the finance department or team within these companies that we lend to or invest in to help them improve their financial picture, to crowd in market rate capital. I would define a lot of like the work that my team and I do as being impact first. So we're not necessarily looking for a financial return on day one, but if we want these businesses to scale, that needs to be proven out over time. And so the way we define catalytic capital is truly patient, flexible capital to be able to work with these companies. And we've been with this company and financing and backing them through multiple loans for almost, I'd say 8 years now, which is a long time. And I think if it was any other regular way bank, which they all have, their purposes in the financial system, they probably would have just wrote it off.
That's a great example. And I think clearly you added a lot of resilience to that business and their ability to operate. Just bring it back to our title for this session. But with that, maybe Vikas, over to you for an example.
Sure. I was listening to you, Jennifer, but I was also trying to decide between 3 companies. So I should be clear that we are a seed stage venture firm. So we invest really early. We're usually part of the first or second sort of significant institutional round that our companies raise. I'll give you an example of a company that's actually based in Brooklyn and is trying to make the essentially tax benefits of one's commute work for all Americans. So if you think about how commuter tax benefits work right now, and many of you who are work at corporate jobs or work white-collar jobs have this experience. You have an enrollment period. You sign up to get the tax benefit of your commute. You put aside money in the beginning of the quarter, the beginning of the year, the beginning of the month towards a Metro card or parking or something like that. It's pretty clear if you spend more than 10 seconds thinking about it that system does not work if you are back of house staff at a Gregory's Coffee or Dear Mama. It is you don't have time to sit in front of a screen for 3 hours and figure out all of that benefits enrollment stuff. But maybe more importantly, since 63% of Americans live paycheck to paycheck, you don't have the money to put aside up front into that Metro card, into that savings account for your parking. So Alice, this company based in Brooklyn, is trying to solve this for back of house sort of service workers, deskless workers. What they do, via what is essentially like a payment technology, is they allow deskless workers to get the tax benefit of their commute as they spend it. Get out of the Metro, on your walk into the coffee shop, you get an AI-driven text from Alice that says, "Was this for work?" They're tracking spend in the background. You confirm that it was. You automatically get the tax benefit of that spend in your next paycheck, about 20%. So no friction, no need to study an enrollments package, and actually the ability to now drive on the order of $400, $500, up to $1,200 a year into low to moderate income Americans' pockets. By the way, this company is a 70% gross margin business. They sell themselves to these small businesses. I mean, if you've ever been to a Gregory's or a Just Salad, this company is what's actually now running the benefits for these for these restaurant groups. And there's a rule in New York and 6 other cities and 1 state, New Jersey, that actually small businesses have to provide commuter tax benefits to their employees. They're not necessarily punished for it, but it is a regulatory rule. So there's a great sort of tailwind here to the business. So it's growing like gangbusters, really strong gross margins, and it's driving new, what we call found money, into the pockets of people. And again, I mentioned the $2,000. The sort of research is if you can get to about $2,500 of sort of liquid cash in your savings account, you sleep better at night. Because that's about the amount you need to get through an average emergency. So this is just, in our view, part of the step in that direction, or a key step in that direction.
And maybe just one follow-up. We often get this question, and I know a lot of our students in Leo Impact are focused quite a bit on how to measure impact, right? I think that's a key practice in impact investing. Is it some of the things you were mentioning there at the end, the amount of savings? How do you think about measuring impact practically, whether it's for that example or more broadly in your portfolio?
So when we have a very specific definition of what we mean by financial resilience, right? And we're trying to move away from financial inclusion, the idea of just getting access to financial services, and toward resilience, which we think is actually the point of financial inclusion. To us, that means new sources of net income, new sources of net worth, and lowering risk. So every time we see a company, we're immediately saying, all right, is this a company that can build a big, scalable, multi-billion-dollar business by responsibly generating one of those 3 things for low to moderate income, underserved Americans? After we invest, it's actually fairly basic. We're just tracking 1 or 2 or 3 of those outcomes: net income, net worth, risk. So in the case of Alice, every quarter we track how much additional, effectively income, cash in the pocket of their customers they're getting. We then, at the end of every year, sort of consolidate that into what we call resilience dollars, trademarked that term. But frankly, we're still figuring out the best way, because these are really not homogeneous. It's very different to mitigate risk with an insurance policy than it is to just have an extra $300 in your bank account. So, we're still working out the best way to sort of like consolidate all of this, but at least on each of those vectors, we track for every one of our companies how they're driving resilience.
That's a great case study, and thank you for bringing that part to life. I'll put a short plug at it. The Closed Loop Partners Impact Report is one of the best ones that I've seen in the market. So for anyone looking to learn more about how you practically measure that, I think that's a great one. And obviously materials kept in circulation is a big piece of that, I know. So feel free to pile onto that, Jen, if you'd like. But the other question I wanted to pose to you as we're getting towards the end of our time and getting into audience questions, climate change is a huge topic for many of our students and an area of interest in impact investing. It overlaps quite a bit with the circular economy. You mentioned materials that go to landfill. The greenhouse gas emissions from landfill is a huge area of focus. And I went to a great event during Climate Week that you all co-sponsored talking about that. I'm curious if you could shed a bit of light on how you think about climate change in the circular economy, whether it impacts your portfolio companies, whether it's an opportunity. How do you think about that for the students here who are really quite interested in that theme?
Yep. So maybe I'll just pick up on that point. When we think about impact metrics, I've been talking a lot this morning about plastics and packaging materials, which for my team is a focus. But Closed Loop Partners more broadly looks at the circular economy through 4 different verticals historically, and it's expanded beyond what I'm about to name. But we're also looking at food and ag solutions, looking at waste valorization more broadly, right? So it's anything that we can do to divert materials from landfill, and what are the GHG emissions that we're avoiding or reducing because of that. We're also looking at supply chain technology and spending a lot more time on materials innovation, whether that be through fashion or textiles, recycling, et cetera. That's also a big focus. I think the other area where we are starting to explore, and the ventures team has made some investments in this space already, is critical minerals and metals, right? And there's a lot of overlap between that area and what the energy transition side of like the climate change picture or story tells. As it relates to climate change and the impact on our portfolio companies, it's something that we're paying a lot of attention to. And I think I'll give 2 specific examples. So materials recovery facilities are responsible for sorting material and essentially producing a bale that they sell to a processor. And when we talk about sortation, it's really the materials that are collected curbside or through a drop-off facility or site. It's the plastics, the fiber, the metals, et cetera. Now, you need sortation facilities everywhere across the country. It is not economical or from a GHG emissions perspective the right decision to be hauling materials, especially things like glass, long distances. It's heavy. And so when you think about where even we've had more recent climate events, hurricanes, tornadoes, storms, we're constantly monitoring what happens with these material recovery facilities, or MRFs, because anytime that they're down, all of that material typically ends up going to landfill, because most of these facilities do not have a lot of excess storage space. That's probably not true when you think about, the Midwest, where there's more land is cheaper or less expensive. That becomes a big problem when you think about some of the larger cities that have been impacted. And so I think about the facilities that we own and operate in Texas, or that we've lent to in that area. We also have a number of facilities in Florida that have had a lot of unplanned downtime because of that. The other, I take climate risk to the infrastructure that I lend to or invest in is on the processing side. So when we talk about processing, it's those bales of material that are going from the sortation facility, typically to a mechanical recycler or to a molecular recycler, like the example I provided earlier. In both cases, there is a lot of water that is being used. And so the process is typically to grind, wash, and then to pelletize or flake that material so that it can be sold to a converter to manufacture new products, preforms for bottles, et cetera. And so understanding in water-stressed areas how we're going to tackle that is also another big focus. For the same reasons around not wanting to haul or move materials long distances, you do need to think about regional hubs. And so I would say it has a lot to do, with how we assess the climate risk of these facilities.
Thank you for bringing that to life. I know it's an incredibly important and timely topic in the midst of hurricane season as well. We're going to pivot to audience questions. I believe it's all through Slido, so we'll look forward to those from the audience. But one last one from me. Again, knowing that we have a lot of students in our audience, I'm curious, as both professional full-time impact investors today, as you look to the future, as you look to build your teams and hire or see others coming into the market, is there perhaps either a future trend that you're keeping an eye on, or a piece of advice that you would give to our audience members that may be interested in a career in impact investing today?
Well, because we are an investment firm, financial modeling, credit skills are always top of my list. But I will say, those are sort of obviously the more technical aspects of it, but there are a lot of soft skills that I look for. Change takes time, and there is no immediate satisfaction that comes from the work that we do. And I think patience, resilience, and perseverance are really important aspects. And so when I interview individuals for roles, I'm looking for passion. I'm looking for someone who is driven by a future vision for change, not just, can you put together a financial model for me and walk me through analysis.
Yeah, I totally agree with that. And I see a bunch of my students here, so you will have heard this before, but I'm not at all surprised that Jennifer and I both went to other countries. We helped to start businesses. We ran businesses. That is, in my view, the best way, if you really care about a specific kind of impact, is going and doing it, not sitting in a nice building in Midtown Manhattan and thinking about it and deploying and sending a wire. It's actually going and doing it. Eventually, after doing that for long enough, I think you then have the skills and the founder empathy and the understanding of the market that it requires to actually do that well. So, I mean, my advice to every student that asks me this, whenever I'm in a panel like this, is go do it. And go work at the startup in the sector. Go work in my space, go work at a fintech company in Austin or Nairobi or wherever it is, and really understand how those businesses work. And then go and try to deploy capital into those kinds of businesses.
Thank you both for that. Really actionable ideas. We have a lot of great questions from the audience that I'm skimming through. Maybe one just to start, and thank you all for submitting these. There's a couple of good questions that tie to this theme of terminology and impact investing. Do you see, obviously with the growth and the mainstreaming of AUM that we talked about at the beginning, do you use the term impact investing? Do you see investors move away from that term? Is this something that's come up in your conversations? We've heard catalytic capital as well. I'm curious either of your views on terminology in the space today.
Yeah, it's funny. I went to a high net worth family office impact conference in Boulder a couple weeks ago, and I came back the following Monday and sat down with my team and I said, we're not going to call ourselves an impact investor anymore, because it was clear to me from that 2 days that something is happening where there's an assumption that if we're at that conference, there is some trade-off happening between the returns my fund is going to generate and the sort of mission, the mission outcome, which is not the case. Our founder track record is top decile fintech VC track record, but we are trying to be out there loudly and say, hey, we have a mission beyond just these returns. So I actually don't know. I wonder if we are doing ourselves a disservice. This is heresy at an impact investing conference, and given the title of this is impact investing. But I don't know if in 10 years we're still going to call ourselves impact investors. I'm already moving in communication of my fund to mission-driven investors, clearly market return focused, but mission-driven investors. I don't know, maybe that moves away too. I mean, in 10 years, really, shouldn't we all just be investing with an intention beyond just the returns? I mean, how boring is it to not do that? I hope that that's just investing in 10 years, but it's a good question. I actually think we're pretty intentionally going to be moving away from that impact investing term.
Super interesting. Jen, do you have any other perspectives on that from the close-up side?
Not necessarily from the close-up side, but maybe more from a personal opinion. I agree with everything that Vikas has said. For me right now, it depends what audience and who I'm talking to. In certain situations, saying that you're an impact investor resonates, and especially when you're fundraising, it really depends. Like we talked about capital sources and where that capital is coming from. In other cases, it actually doesn't help me at all, right? Because people do immediately jump to this assumption that there's a trade-off and that I don't care about financial returns, and that's not true, right? Again, like catalytic capital, it's a means of helping a business scale, and it's really about flexibility. The goal is to make sure that we're picking the right companies and lending our credibility, right? Close-Loop Partners has been doing this for 10 years. There's a lot to be said when we select to lend or invest in a company. And I think also in the future, we're already seeing it now, there's a lot of acknowledgement around the risks that are associated with certain types of investments. And so you have to be intentional. It has to be part of what you're doing to have an impact, to understand what the outcomes will be.
Yeah. One other one, maybe Jen, for you to start, given that you deploy both debt and equity capital across Close-Loop, I'm curious if you could talk a bit about how your diligence may differ between debt and equity, whether that's on the impact side or the financial side.
Sure. I think when we are looking at companies and considering debt versus equity, it has a lot to do with their stage of growth. Our goal is to provide non-dilutive growth capital. So I think we're always starting with the intention of trying to figure out, can said company or project actually service debt? Is that feasible? What I'm typically looking for is if a company has the ability to generate cash flow and to service debt within an 18-month period, my preference is to offer them a loan. If they can't, or if it's a true technology play where it's not a CapEx intensive business, then I'll probably look at equity. And just to make sure that I don't confuse the audience, when I talk about the equity investing that I'm doing, it's typically slightly later stage. The ventures team is looking at pre-seed and seed stage opportunities, and I'm looking at probably, call it Series A, B, and later.
That's really helpful. Vikas, maybe one for you, a bit more pointed where you're playing in the capital stack. What are some of the things that catch your eye when you determine a quality pitch for scale? Are there features that attract you as an investor to earlier stage companies?
Yeah. In terms of specific business models, we only invest in, we call it embedded fintech, but really what that is B2B2C models. So we just think the era of trying to build the next sort of direct to consumer fintech is probably past us, at least for the short to medium term. Those are not really businesses that are fundable by other venture investors. So we only invest where essentially the fintech product or service is sitting on top of an existing value proposition to a customer, where a customer is already engaging. There's existing distribution, data advantages, trust advantages that the fintech product can sit on top of. That's sort of the shorter term path to scale that we need to see. And then when we're doing diligence, we want to make sure that there's evidence of that channel actually working. But then more broadly, I'm investing so early that so much of this is the founder. It is. And we call ourselves resilience because we're trying to drive financial resilience, but resilience is really what we're checking for with our founders. What have you been through? Where does the grit come from? Because founding a company is one of the hardest things. Founding and scaling a company, I should say, is one of the hardest things there is to do. So we're really trying to gut check and do reference checks for resilience from our founders.
Yep. And maybe in the last minute, one other question, in addition, kind of flipping the focus from the investees, I guess, where you deploy capital to the investors. We did talk a bit about the different sources of capital. Are there any examples, or what do you look for in investors? Have you ever chosen not to work with an investor because they've not been aligned with your mission, or is that not come up for you? Any observations on the investors that have come into your strategies?
There have definitely been companies that have expressed interest in investing in closed-loop partners, whether it be in an investment vehicle or in one of the other entities that I mentioned earlier, and we have turned them down. Like, when it comes to investors, there needs to be a true commitment, especially when we're thinking about corporate as LPs, that they're going to transition. And I can think of a lot of companies that talk about it, but don't actually action it. They don't have any strategic plan around transitioning from their core business, which is sort of anti-circular economy.
Super helpful.
Yeah, I can say definitively, we have never said no to an investor. We do an OFAC check. Like, if they fail the OFAC check, we wouldn't let them in, but I can't imagine not letting an LP in. But it's just like it is with our companies. There's like a meeting of the minds, and they're only talking to us because they believe in it. They understand this thing that we're trying to do, just like with the companies we support. So by the time we get there, and they're really interested, there's usually a real interest in our mission and our returns.
Well, thank you both. We could go on, I think, for another hour hearing more about your expertise, but I just want to acknowledge we only scratched the surface of all the questions that came through from the audience. So thank you for your engagement and your very good questions. I hope we did a slight service to that. But thank you both, Jen and Vikas, for your time and your expertise. And thank you to the Leo Impact Student Fund team, the Tamer Institute, and everyone involved in today. Please reach out and get to know the students on our Impact Fund, our board members, and Jen and Vikas as well. Thank you all very much.